Hey, what's up, guys? I have the video pulled up on my laptop, and it looks to be very clear. So it might be a connection issue, Rock. Haven't had a whole lot of coffee yet. Still trying to wake up. I think all of y'all have seen the stream from last night, right? I know Evie wasn't attending, but did you catch up on the recording? Oof. Shame. Yeah, definitely just catch up on that whenever you can.
I watched a little part of the last video, not all the video, just a little part. Hello guys, I'm Anis by the way. Hope everyone is feeling good today.
Sweet. How's it going, man? The first part of the video can be a little bit redundant and boring because it just goes over how to build the project. So if you already know how to do that, then you're not really gaining that much. But after that, we talk a lot about just a lot of core concepts that you really need to understand before moving forward. I'm definitely going to repeat those, on maybe some on this session and in the future ones, but watching the first video definitely gives you a good idea. Cool. So we're going to start off with.
I get what you try to explain during the first video, but the the builder parts, I was not really following when you were doing the builder strategy manipulations. But I got most of the ideas you explained about how the process should be and all the stuff related to theory, but not practical steps. I was not really focused on the practical steps.
Are you referring to the video I made last night?
Yeah, the one with the video and audio, the only one that have video and audio.
Okay. Yeah, maybe in your spare time, try to,
Yes.
I guess, narrow down specifically what you're not understanding, and then we can just go.
No, but since we are going to start over the strategy, I think I will catch up by the end of the session.
Okay, yeah,
I will. Yeah.
more than likely, I can see that.
Yes. My accent is not weird. You can understand me.
I've I've dealt with a lot of accents. Your English is pretty good, so it should be fine.
Okay. Okay. Perfect.
Where are you from again?
Morocco.
Morocco. Okay.
Yeah, Morocco.
Usually the ones I have a little bit trouble with is Indian or Swedish.
Yeah.
Those can be a little.
I I know Indians can talk very not clearly. Us too, because we speak French.
Mm-hmm.
So so we have. But French people usually speak good English. So that's why I think we are more understandable than English or than
Perhaps.
Indians. Yeah.
All right, so we're going to talk about the orb for a minute. That's opening, that deals with the opening range and then a breakout beyond that range. So just right off the bat, I like how simple the premise behind it is, because it's a pattern that is without a doubt, relevant across all assets almost. I mean, I can't think of any assets that it wouldn't be present on. Falls in line with momentum, and it is primarily used for a intraday momentum pattern. And I guess the core premise behind why it works is because I guess kind of the theory is, if a market is going to have a big uptrending day, then by nature it has to break out of that opening range, because if it doesn't, then of course it's going to stay within that range and not give us a trending day. So it's almost a very real-time indicator that a trend, that we might get the market regime that we want, of course that being a breakout and a big trend following that. Initially got brought up by Gonum in the strategy ideas channel. You can see he has some conditions listed. Super trend up in 3 time frames, so he's trying to use like a triple time frame, a trend confirmation. RSI needs to be below 50. The QQE crosses the fast line. Only trade second, third hour after the open, and it has to be somewhere in the middle. And then he had to sell when you hit the opening range high, which we are recreating this. At first, we built all of these conditions, and then we found out that the more we took away from this, the better the strategy performed. And if you watched the video last night, you saw how we need to start with our baseline. And our baseline is just getting, extracting the core performance of whatever potential pattern that we're trying to exploit. Whereas a lot of traders will kind of almost ignore the premise behind their pattern they're trying to exploit, this being the orb, and right off the bat use a bunch of indicators, and they're not using any data or anything to even see if that indicator or that filter is even improving the baseline. So spend a lot of time creating this version first, just to kind of give a real-time example of the difference, but instead we're going to just start with the baseline of the opening range breakout. So spoiler, having all these additional confirmations just made the strategy tremendously worse, and that's the case with most strategies. So we can go ahead and start with just the orb and trying to extract, or basically try to find out how we can use indicators to just exploit the core pattern. This one is very simple. We just need to identify the high and the low of the opening range. We're going to be using the 30-minute opening range, but the time period of the opening range definitely opens up a couple more doors, because we could have a 5-minute opening range breakout, 15-minute, 30-minute, even an hour. And honestly, range analysis is, really just offers a lot of opportunity across the board. But in this scenario, we're just going to be checking out the 30-minute opening range, which is the Um, Probably one of the most commonly used opening range breakouts. However, I know a lot of traders that like to just use the 5 minute opening range for scalping purposes.
Akoshik,
Yeah.
I have a question. So an opening range, is it a breakout or something?
Yes.
What's
I mean, there
exactly?
there there are definitely different ways to trade the opening range. In this case, it is the breakout, hence the abbreviation ORB. So the pattern we're trying to exploit is when price breaks beyond that opening range, and then
So an
we get a continuation, right? So price breaks up and just keeps on going.
so
So the ideal scenario where it will be price breaks the range, keeps on going up, and then we close our position whenever the market closes.
what's the difference between a normal range and an opening range? What's the difference between the difference between a normal range and an opening range?
So really, the only difference here is, I mean, we're specifying the opening range. We're saying we're going to use the opening range, but
Okay.
that raises up a good question. So we can build this, but the question is, does the opening range and the breakout from it perform better than any 30-minute range? So maybe a 30-minute range that starts at a random time. Does it even perform better, or do we just right off the bat have this bias that, the opening range performs the best over a series of trades?
Yeah, but me, I asked the question mainly because I didn't know what is an opening range. So an opening range is a range that occurs at the opening of the session. That's an opening range.
Correct. So in this scenario, we're going to be using the New York Open.
Ah, okay. So
So it's
so it's a range.
the New York Open, and then 30 minutes after that, you look at the high and the low. Because once again, the theory is if the market is going to have a large trending day, then it has to break out of that range.
Okay, so open low after 30 minutes.
Say it again.
High and low after 30 minutes is the range.
Correct.
Don't you be
You,
okay?
you got it. So let's go ahead and check this out on the chart real quick. This is a chart from the project. I already have that right there, but I want to show y'all how to pull it up yourself. So we'll just pull up the NQ, 5 minute. So I already shared a indicator for the opening range in the download links. You see it's right here. Orb indicator that is compatible with the builder. And compatible means that the value plots that indicator has are able to be selected with the builder and therefore can be used. Like Reagan here, he shared an auto fib. He wants to make a strategy based off the Fibonacci's. I haven't checked that one out yet, but it won't be usable inside the builder if those extension lines aren't created as value plots. Luckily, I already have several Fibonacci indicators that are compatible, so if it doesn't, it's not a big deal. So once you download this, you can pull it up onto the chart. And so this opening range indicator lets you specify what time period you want for the range. which is very useful, um, if you want to experiment with other potential ranges. So this already is set correctly to the opening range for me, which is 830 to 9. And you can see here on the chart, it actually gives you two ranges. So it gives you the range of the entire session, since this day actually starts it's like 5 p.m. But all we want is the opening range. So just to make it easier on the eyes, where it says show pre-session, I can just uncheck that box, and now we only get the opening range. And it's kind of hard to see these blue labels, so I can go back into it. I just want to change the color of these labels so that we can see them clearly. There we go. So here's the opening range. So these are 5-minute bars. We can count. So I got 5, 10, 15, 20, 25, 30. So after this bar closes, it just maps the high and the low. And then on the right, we can see it labels the individual lines. So we have the opening range high, the middle of the opening range. We have the open price, so this is just where the market opened. And then we have the opening range low. Cool, so now we can go into the builder. So we have new strategy, and here we can name it. So we'll just name it something I haven't already named all these other ones. We'll just do orb. I already have an orb one. We'll do let's do orb video. That way I just know this is the one I did the video on. Orb video, default properties we can keep default for right now. Additional data, we'll leave it as is. And this, could you perhaps mute your mic until you come back in? Cool, I appreciate it. So conditions and actions is where we can build our first condition. And so right now we're just trying to extract, basically how can we exploit this pattern in the simplest way possible. Really easy with this one. We can just say when price closes above the opening range, we go long. That's all there is to it. The way we can do that is go to price, choose the close, crosses above, and now we have to go in and choose the opening range. Here we can hit plot on chart so that we actually see this on the chart while the strategy is running, or whenever we're looking at a chart of it. Now here I can't really manipulate the plots like I did over here on the normal chart, but I still don't want that pre-session to show, just to make it easier on the eyes. So,
question, please.
Okay, yeah, go ahead.
It's not related to the strategy. It's more about importing the indicator. So I'm trying to import the indicator. I'm clicking import. Then I click Ninja Script add-on. I should click something else.
That that's right. Go to Tools, and then Import Ninja Script add-on, and then you just choose that
Uh,
one.
then I get an error telling me that it's not compatible. The current version of NinjaTrader is not compatible with. Yeah, selected file was made from an older incompatible version of NinjaTrader, or is not a script archive.
Shouldn't be saying that,
Ah, it's just a warning.
because
Okay.
the oh, it's a warning.
Yeah, it's not an error
Oh,
or something.
oh, okay, yeah, that's right. Yeah, I think it's yeah. I think I
It's,
recall now. If you try to import, sometimes it might say like I
it's a
can't remember
warning.
exactly. It's something about a warning, but you can't just bypass it.
Okay, okay.
It's been so long.
Uh,
Um, so yeah, I only want the opening range to show up on the chart. So here, this is the area where it would show the entire range. So I'm just going to change it to the opening range I'm going to be dealing with, which is 8:30 to 9. And so here on plots, we can choose the value plots. We have a lot to work with. But here we're dealing with the opening range high. Okay, we're only creating a long strategy right now. And then down the line, we can create a short variation. So close crosses above opening range high. That's the value plot. Hit OK. And then the other thing we need to add is time filter, because we only want this to occur after the opening range is established. So we go to time series, greater, time value. I'm going to be choosing 9 a.m. Go to order management, we enter long. And so now we're on to our other set, which is going to be a condition, or our exit condition. And this is really important because all we want here is essentially a trailing stop that is going to let us ride out these trends that can potentially occur whenever an opening range breakout happens. And so the type of dynamic stop that you might use would be like a moving average, really just a plethora of moving averages you can use. But the one I normally like to start off with is just going to be an ATR trailing stop. And I actually already have that posted in the indicators as well. The ATR trailing stop. Go ahead and pull that up. So the way we're going to do it with this one is this indicator. Well, first, so just so you can see it, I'll pull it up on the regular chart so you get an idea of how this looks. So I don't know if you are familiar with this type of indicator or not. What it does is right now we're using the past 10 candles. I like to put it at 14 because normally 14 is any default ATR. So it looks at the past 14 candles, takes the ATR, times it by 3.5. You can see here we have the multiplier set to 3.5. and then plots us a dot, and it just trails that, and it goes by the close price. So it's not going by the highs, it's going by the close price. We can change it to the highs if we want. If we say, well, we want to get out if price retraces more than 3.5 times the ATR from the highs. So we can change the input to price and then the high. And then you can see it basically just moves this up a little bit because now, of course, it's going by the highs and not the close. But we're going to keep it at the close. And you can see this also gives us trend direction. I apologize for the train. It'll pass in a moment. But you can see here, whenever it closes, it has to close. If it closes beyond that trailing stop, then the trend flips. And so the multiplier setting is going to dictate how strong, or I guess a better word, how sensitive the ATR trailing stop is going to be. For example, if we increase it, then you can see it becomes a lot less responsive, lags more, however you want to look at it. Whereas if you make it tighter, we get something more like that. So an indicator like this that doesn't just give us plots, but gives us trend direction can also be made available in the builder. I want to have this plotted on the chart, so we'll hit plots. I like using the modified ATR. It's just slightly adjust the formula, which I can make available in the future. Change the period to 14 because I like it to be default. And then here we have several value plots. So we have the stop dot and the stop line, which is essentially the same, which are, the lines and the dots you can see here. And then we have trend. So this indicator was created to where whatever current trend it has, it outputs a number, which makes it very easy to utilize. So we're going to choose trend equals, go to numeric value, I'm going to do -1. So -1 means that we're red, essentially. It means that we're in a downtrend. And so before we add this, we got to go back to our first condition, add this again, and just say we only want to enter long if we are blue or we're in an uptrend. Now, normally I wouldn't need to add this because in almost all cases, whenever price breaks this opening range high, we're definitely going to be blue anyways. But this is just to just to ensure that nothing really awkward happens that can definitely occur over the course of thousands of trades. So trend has to be up for the entry, and then we'll exit when the trend is down. Simple as that. So now we've found a way to exploit this potential breakout without creating any initial constraints. Because the more constraints we have, well, we can get into constraints. So on this exit condition, just go to order management, exit long position. And right off the bat, why I like using this ATR is because I can quickly optimize this multiplier very slightly to see how much sensitivity I need to give to these trends. I like to keep it very tight. ATR multiples are used in just so many algos because they're extremely good for tweaking against different instruments. And so what I mean by that is the ES contract might have uptrends that aren't as volatile, aren't as noisy, don't pull back as much. So the best parameter for that might be 3, a slightly tighter deviation of the ATR. Whereas on the NQ, those trends are a lot more volatile, a lot more noise, so it might benefit more from having the ATR at 3.5. And this, of course, this concept correlates with a lot of other assets. But the key takeaway is it has to stay really tight, so I like to mess with it like in between 2 and 5 at most. Because if I was trying to optimize like from 1 to 100, that just erases the premise, and then we're just overfitting. So just a very slight optimization there. And also we optimize across a basket. You'll probably never see me optimize on one instrument because I don't get any information from that. It just tells you what parameter performed best over this period of time, not what the most robust parameter is, which is always what we're going for. So I want to make this multiple as an input so that I can optimize it. So
They say that, sorry, Akotic,
go ahead.
they say that the best parameter is the one with the best neighbors. I don't know, I think it's false, not the case. Because I tested this idea when I'm trying to optimize in the past. I was trying to optimize. I remember like having good neighbors, but the strategy keep failing in the forward testing. But the sample size, like,
I think I'm not following what you're saying. You say good neighbors?
yeah. So let's say, for example, you optimize your ATR multiplier, and you find out that on multiple assets you have the best value is let's say, for example, 5, but 5.5 is failing and 4.5 is failing also.
Correct.
And at same.
Yeah, so I see what you're going at there, and that's a very good example and something I will touch on. Whenever we get to optimization, we want to look. I'm just going to skip ahead for a quick second and come back because this is off topic.
Yeah.
But we want to make sure that our iterations, right? So if I optimize from 2 to 5, I want to be profitable on every iteration. 2, 2.5, 3, 3.55, because the core premise is still there. And that also falls in line with why we have to build from the baseline and look to add these little tweaks. But yeah, so if you optimize and the best parameter is 5, but the strategy blows up on 4.5, then you've overfit. Something's wrong. So yeah, I'm glad you brought that up.
Yeah, of course.
So real quick, let's add this multiple as an input. We're gonna go to back to our inputs and variables. Go to add on this upper section. We're gonna go to we're just gonna call it ATR1. It has to be a double because it has a decimal. And we're gonna make the default 3.5 and the minimum 0.00. And real quick in this, that also falls kind of in the category of validation. When we start to really see how robust our strategy is, start looking at optimization curves, just really putting it in like extreme robustness tests to gauge our expectations.
Yes, I see. Have you ever tried to optimize more than three variables?
Years ago, until I
Yeah,
found
years ago.
until I found out that is not. I mean, dude, when I first started, I was optimizing
Yeah,
10 plus
yeah,
parameters. Thinking I was creating holy grails over here.
yeah, yeah. I see. I see. But again, no. The let's say after if you optimize five parameters, but on each combination of the parameters you have, let's say for example, thousands of threads. You
Mm.
still won't go with this scenario. You still won't optimize four parameters, even if the sample size is huge. Like you have
If
thousands of
I
threads.
Yeah, if I had five parameters that I was optimizing, I don't think there's any sample
Yeah.
size that would make me feel confident, to be honest. And
Oh,
a lot of people start optimizing, not even thinking about how that affects the baseline, like what our core premise is. Like all we're looking to do is find a strategy or use indicators to exploit this pattern, right? We're not looking to combine all these random indicators and parameters to like just overfit the shit out of it to see what performed best historically. That there's no point in that. You want to just have a simple strategy that will fully exploit this pattern whenever that pattern occurs, so that you can confidently say when a good opening range breakout occurs, this strategy is going to make bank on it. That's all we're trying to accomplish.
yeah, I see. So three parameters max, I guess. Going to be the max that we are going to do.
You'll rarely even see me do that much. I mean, to be honest. To be honest, I like to only optimize one, and then keep that range extremely tight. Like here in the ATR, I'm just gonna be doing from 2 to 5. And then because of the premise, you also need to have, I guess, a premise behind why you're optimizing it. Before I told you I was going to create an input for this, I told you exactly why, you know, and it's because of the trend strength, how trends could potentially be a little more volatile on different assets. So a slight tweak to the ATR input, which honestly, it doesn't affect our trigger at all. It just affects how long we're staying in trades. So having a slight tweak for the volatility of trends makes perfect sense to slightly optimize. The best example of that is like how I was saying for the NQ. I've looked at NQ and ES for a long time. That's normally what most people start with when they even get into futures. And the trends on the NQ are a lot more volatile. So often requires a slightly more aggressive trend filter.
Yeah, you are completely right. So the more the volatility, the more freedom you need to give to the trade, so that you won't get stuck.
Precisely. So I think we're all good here. First, we created our input right here, but now we have to set that input where we want it. So we go back to our ATR condition, make sure that's plotted on the chart. Sometimes it does that. I gotta not double click it too fast. And now go down to ATR multiplier and click on ATR1. And so here's another good example. I could easily optimize this ATR period as well. But why? There's no premise behind optimizing it besides satisfying useless curiosity to what maybe the best period was. Just using the ATR multiple is more than enough. Let's go to our other ATR and choose that ATR1. Let's go ahead and compile.
I remember optimizing them both, the multiplier and the the number of bars. I
Yeah.
optimize
Yeah.
optimize everything. Yeah,
All right.
but again, I was focusing mainly on forex. I think that's a big issue. I think the fact of me just doing forex is because there is no trends in forex except some few pairs like GBP GPY. I think it's a pair that tend to have trends, but the others there is. Have you ever found something like a trend system on forex?
Yes. Whenever I used to
Yes.
make, because that's actually what I first started making algorithms on years ago. And I mean, the best systems I've made for Forex were only on the daily chart. So daily trends. Um,
Yeah. What about the simple size on a daily charge? Was it huge enough, big enough?
no. uh, of course, and I didn't have access to basket testing either, so I was just, making a system for like the Euro USD, and then I'd run the strategy on the pound and it would explode, and then, it's just because the strategy wasn't robust and it was just overfit. So, but yeah, making daily systems, I think that's still a viable approach to making, trading like the major 28 pairs on like the daily chart. I'm not saying, I mean, I'm sure today if I really focused on it, then I could, make some trend systems for the lower time frames. But as we saw yesterday, we got some really good insight that mean reversion appears to be a lot better for forex pairs. So in the future we might, actually work on some forex strategies, but are more mean reversion based.
Hey, amazing.
So let me make sure this is compiled again, and then we can go to the strategy analyzer. Do this one. Okay, cool. So this was the orb we were working on last on the couple of sessions ago, but now we're on this one. So let's go to, what did I name it? Orb video. Orb video. Cool. So right off the bat, I want to set this optimization up. So on backtest type, let's choose optimization. And on the ATR, we're just going to be choosing the minimum of 2, a maximum of 5, and the increment is only going to be 0.5. So I think that gives us like 8 possible iterations. We're going to choose our basket of indexes. And we'll start off, this is an intraday system, so we'll test on like the 5 minute, the 4 to, or the 5, 4, 3, 2, and 1. Let us include commission, and we want to aggregate the results. So this is a really important box to check, because what this is saying is that we want to see the best result, the best. Well, first you need to know that this box only appears whenever we are on optimization and whenever we choose a basket. So if I chose only the NQ, then that box wouldn't be there. But since we chose a basket, now we need to specify, well, do we want to get the best parameter on each instrument, or do we want to get the best parameter over all of them? I always want the best parameter, all of them. So right off the bat, I'm putting something in place to prevent overfitting, because I don't want the best ATR value on the NQ and the best ATR value in ES. Right now I just want the most robust parameter across all of them. And then later in the stages, way later on, whenever I'm thinking about potentially deploying this, that's when I might tweak the ATR just slightly for individual assets. So let's keep it on aggregated. The fitness function, we're going to choose maximum net profit. Not going to add slippage right now. That falls more in line with robustness tests. But definitely want to add commission, of course, because that's our cost of doing business. So yeah, I'm going to run it from 2 to 5. And I'm going to start off with just doing the last quarter of 2022. Obviously, this is nowhere near enough sample size. This is just getting our general test out of the way, seeing how the pattern is performing. And since we're on an intraday chart trading multiple assets, it should still give us a somewhat decent sample size starting off with. Let's go ahead and run that. So there we go. It gave us that the ATR is currently, which is pretty tight, 2. But right off the bat, just looking at the core pattern of the strategy, we're profitable on all 5 assets. You can go ahead and check out the charts. Let's check out the chart on NQ.
What's the drawdown? It's a little bit blurry for me. The total drawdown.
Yes, total
Okay.
drawdown is 5,000.
Wow, 5,000. So 10%. Amazing.
Yeah, it's actually a really good ratio starting out. Right off the bat, we're on a 10-to-1 ratio. So that's kind of the first rule of thumb if you watch my other sessions. I want at least the max drawdown to be 1/10 of the net profit. So that's like a good starting point. Just a good 10-to-1 ratio. And then whenever we get into, and you'll see the more assets that we add to our list, it will often decrease the drawdown even more. And that falls in line with that diversification up to 20, 30, 40 to 1. I start getting, a little more excited once we get, the 25 plus, because that's some really good numbers.
25 to 1. It's straight up a straight line.
You'd be surprised how the equity curves look at that time. But that's definitely like portfolio curve. Like the portfolio curve will look really good, and that's what we want. We want our portfolio curve to work really good. The individual assets, individual strategies, aren't, it's not what we're going for. You don't want like a perfect equity curve on YM, because that's just overfit trash. But portfolio curves, with algorithmic trading, everything is pretty much looked at on a portfolio standpoint. Unfortunately, NinjaTrader doesn't give us any visuals for the combined results.
Yeah, I wanted to ask you about this.
Yeah. So whenever I get ready to do portfolio analysis, I have my Excel files. So I export the trades from NinjaTrader. I made a macro to just convert the format, and so that way I can do portfolio analysis within Excel. That's definitely, way later way later on the path as well. So first, let's check out NQ. That's our best performer, which is normally the case with the indexes. And let's just make sure that our setup is, so right off the bat, I didn't compile this correctly because or just the plots. I don't like seeing that other range. Let me see why. 8:30 to 9. Custom period. I think I needed to choose custom period.
Yesterday I was messing around with using multiple entries, like entries by per direction. You see that
Yeah,
input.
yeah, the entries per direction.
So mainly, if I increase it to, for example, 2, it means that if the signal occurs while a long position is open, the strategy analyzer will check another position, even if we have one already open. That's the
Not quite. That's what people think it does initially. Actually, if you have it set like this, if I just increase this to 2, then it would just open an additional contract at the exact same time, since that
oh,
condition is true. So you have to set it to unique entries. Sometimes I get it mixed up, but once I get into scaling, and adding to the position, then you got to do some fancy stuff in the builder and then set it to unique entries so that they're unique. And we'll definitely get into that as well at a different time. But right now, if I just set it to 2, then it's just going to enter an additional contract at the exact same time.
if I do unique entries and I set it to 2, is it going to be like 2 different entries or not?
Without adding anything to the builder, I can't really remember off the top of my head. We can run it real quick just to see. So in this scenario, like we'd want it to enter long here, and then you're saying if we come back below, then cross back above the opening range again, then we'd enter again.
Why I'm asking you this? It's because it's going to give us more trades, and yeah, true, the trades might be correlated because you will have 2 trades open it at the same time. There is some correlation between the trades, but at the same time having like 1,000 trade with like a high with 50% correlation, still better than 360 trade with no correlation at all. Because 50% correlation on 1,000 trade, which means that we have 500 uncorrelated trades. So I guess having
Just yeah,
allow
just adding to your winners definitely. I mean, there's a lot of ways to do that, and we'll definitely work with that soon. Because
yeah.
you're right. I mean, I don't give it as much weight as completely individual trades. But you're
Okay.
right. Like if I put a condition in there where I'm adding to my winners, then it will definitely drastically increase the trade count here on Ninja. But just keeping that in
Like
mind.
by adding to your trades means that once the trade is winning money, you will add the size. I
Yes.
mean this. Oh, okay. But me, I'm talking about every time the triggers occurs on the market, we open a position. Even if there is a long position, if the conditions are met once again, even if we have a long position, we check another position.
I see what you mean. Yeah.
Is it possible to do that? Because it's going to amplify the sample size and
Yeah, I mean, it kind of strays away from the premise we're looking to capture right now, but
Ah, okay.
I wouldn't say you're wrong.
Oh,
Because right now, using our ATR trailing stop, we're kind of using as a kind of an indicator to gauge the like how much leniency we need to give the market once we do enter a trade. So if we entered
okay.
long here and entered long again, since it's all the same trade essentially because the ATR hasn't changed, then you're right, we are, amplifying our trade size, but it's not, it's kind of misleading in a certain way where we're not getting like a more true sample size to the performance of each individual opening range.
Ah, okay. I see. I see. I see. I see. I see. Ah, we because because the opening range is not a signal that will. I got you. I got
Okay,
you. I think you are right.
so so right off the bat, this is a good sign that this pattern might have some potential. Of course, we already know what it does because the opening range breakout is just uh, it's just a really good intraday play. It always has been. And what's important here is we've created a strategy that exploits this pattern whenever it occurs 100% of the time. And what I mean by that is something very important to talk about. A lot of people will, one, create strategies without even knowing what premise, like they'll just be talking about indicators all day without even talking about what pattern they're trying to exploit. And a lot of times they they won't even know. And so what can cause that to happen, what can happen as a result of that is, say you created a strategy that is, supposed to bank on opening range breakouts, and then tomorrow an opening range breakout occurs, but you didn't get a signal, you know. If the desired market pattern occurs that, you're apparently built a system to exploit, and then when it occurs, you're not even in the trade, something's wrong, okay? That means that you've put what I call constraints on your strategy. And a lot of people put these constraints because they think it improves the strategy long term. And in reality, it just hinders any possible edge it might have. And we we illustrated this firsthand whenever we built the strategy that Gonum posted. Right off the bat, he wanted the super trend to be up in like 3 different time frames. The 15, 30, and a 60 minute, because he believed that, okay, if I have all this extra trend confirmation, then it's going to improve my results long term. All it really did is make him miss countless opening range breakouts that did occur because he had all those constraints. On this strategy, we don't even have a trend filter. We don't have a regime filter or anything. The only reason why I said that the ATR trailing stop needs to be up is so that there wouldn't be a coding error, essentially. Because if I didn't specify that, since our exit condition is when it changes to red, then it could potentially give us a trigger when the trend is red, in which case we would have a infinite stop loss, which is not what we want. So it's important to just create the baseline, which is what we have here, where it just exploits this pattern in the simplest form possible. And you could see, you know, yeah, it takes losses all the time. It takes small wins all the time. You know, it takes all different types of small wins and big, you know, all across the board. But we don't really look at the individual trades. We just make sure that it's exporting the pattern properly, and then we look at the combined results to see if there's anything there. And then we can use this as our baseline and then start adding small, you know, very small rules, tweaks, money management. So real quick, before we move forward, right here we tested on the indexes. I just want to see how prevalent this pattern is on other asset classes. But first, let's see what time frame this opening range breakout does best on. I think it's going to do better on the lower time frame, slightly lower time frames, simply because there's more candles it has to work with, since this is an intraday strategy. So we're going to go down to the 4 minute, run this optimization again, and real quick I'm just going to mark down the combined stats. So we got 54k minus 5k, 1.54, 360 trades. Let's go ahead and run this on the 4 minute chart. And also our parameter was, it shows the 2 ATR on the 5 minute, whereas the lower time frames have more noise, so it should choose a slightly higher ATR. Give me 1 second. Okay, I'm back. So it still chose the 2 ATR, but our results did improve pretty significantly, actually. So we got 260k. Normally I take a screenshot of the summary screen, but just, you know, for these videos I'm just gonna be typing in these stats real quick. So 60k minus 4k. I just use the first number. You know, I'm not gonna type in 4,482. I just don't need to be that extreme right now. 1.65, 372. Go on down, and we can see on our chart, you know, it's still executing this pattern in the correct way. And so one of the other constraints that Gonum put on his strategy was to only look at the second hour and third hour of the trading day. So I mean, another example, you know, right off the bat, he just believes that that condition, you know, the close above the opening range, only, you know, is best at that range of time without even, you know, without even confirming it, without even knowing. So that's why, once again, we start at the baseline, and then we'll do a time of day analysis. You know, we'll look at the performance by hour of day, by day of the week, all the seasonality metrics to really see, you know, when this strategy performs best. And obviously when we start doing stuff like that, sample size is extremely important, you know. So let's move on down to the 2-minute chart. Or actually, no, we need to do the 3-minute. NinjaTrader is starting to glitch on me. It does that once you start using it for too long. You gotta restart it. Yeah, so whenever gold and I start trying to, in years. So once, I'm not gonna really be able to do like significant time testing during the streams, obviously, because my stuff would just crash. So normally for in sample, I like to have at least 5 years. Depends on the time frame as well. But normally, that's why I had y'all start from 2015 when y'all downloaded your data. That's also pretty much as far back as it goes for all like the odd products, like other futures contracts, whereas the indexes you can get back from like 2010. But depending on the time frame, doing like 2015 to 2020, if you get, that's going to give you a pretty massive sample size if you're doing basket testing. Definitely use that main list that has over 20, has like 25 products. So if you're doing, 25 products, 5 years, even on the 15-minute chart, you're going to get really, really good sample sizes. So 61 minute, not 61 minute, the 3 minutes actually did not give us better results, and you can see the ATR value increased. So another reason why I like using the ATR value, because it tells us that since it chose 4 as the best parameter versus 2, it tells us information being like, look, if you want to exploit these potential uptrends, then the best route to take is allowing the market to fluctuate more, which is just simply always the case when you're dealing with lower time frames. There's a lot more noise. So you have to allow it to, fluctuate more. Whereas, discretionary traders think that, if I use a really low time frame, I can use this really tight little stop loss, then I can take really massive size, then I'll blow up next week, and that's just not how it works. So I'm gonna see if I can run this I'm gonna save my workspace. So whenever NinjaTrader starts to freeze up during these optimizations, I just save my workspace in case it crashes or anything. Or if it freezes so long to where I have to manually close it. So we'll test it on the 2-minute chart. Well, I like having a baseline, and it depends on time frame, honestly. If you're not trying to overfit your strategy and your system is very simple and robust and it exploits a specific pattern, then I don't really need a sample size of 20,000 plus. But I definitely like it in the 5 to 10,000 range. And depending on how your strategy is working, um, what time frame you're on, what type of trigger you're using, it's going to really affect your sample size. At
Okay.
minimum, at minimum, I at least, want to pass 3 years. So that gives you a good idea. What's up in this?
Uh, I still can't spot the HER multiplier that the strategy chooses. Where, where is it?
Oh,
Where is
yes.
it on the?
Yes, so for here on the 2 minute, like I was just saying, we now lowered the time frame a little bit more, and what happens? The ATR is now choosing 5, which is our highest possible iteration, which falls in line once again with what I was just saying. It's telling us that now there's even more noise, so now we got to have an even higher ATR value.
Okay, so you never use short strategies on indexes and yeah, because right now we are testing only on indexes. You don't use short strategies on indexes.
I do.
Okay, amazing.
We just haven't gotten to that part yet. But yeah, I mean, for right now, we're just working on the long side. A lot of times, short
Uh,
strategies won't have the same, um,
yeah, Richard.
yeah, they're not going to have the same structure. They don't, downtrends don't respond the same way.
Okay.
So, as far as seeing, what type of trend, what possible trailing stops I might use to capture those downtrends is more than likely going to be different than what I use to capture an uptrend. So,
Okay, so it's not going to be the same strategy. It's going to be another strategy.
it's going to be more so what I would call a variation. So
Variation.
yeah, there's definitely going to be a lot of different variations of the opening range breakout. And then I'm going to get into why, at a later time, why running strategy variations is extremely important. And it's the same purpose behind why we diversify as well. But but yes, having variations is really important to fully exploiting a potential edge that any pattern might have.
Another question.
Yeah,
Is
it's all good.
so the the 66,000 return. So to make this kind of return, what's the requirement in terms of capital? It's one contract per trade. So knowing that futures allow leverage, I think it's not going to be that much, right?
Correct. So when it comes to deployment, you you love skipping ahead, but that's perfectly fine.
I'm
uh,
sorry.
it's all
I
good.
just want to know is do I
Yeah,
need because I never traded futures or I traded stocks, but on those the brokers that allow splits, so you can buy a fraction of a stock. So I don't know what's the
correct.
requirement.
So starting a couple years ago, futures became more available to retail with the invention of micro contracts. Okay, so right now we're trading on the main the main contracts for the indexes. EMD, ES, NQ, RTY, and YM. They have micro contracts for all of these indexes, which are a tenth of the tick size, a tenth of everything. So what that means, to give you an idea, so for the ES, um, most brokers now only require $500 in order to take one contract. So the margin required for one contract is $500. In which case you could have taken the contract size that we took here on the ES. The margin required for the other indexes are, of course, a little bit different. But just to give you an idea, the margin to have these trades intraday is only $500, and intraday margin is what it's called. Now, if you want to swing it, margin increases, obviously. But so there's an idea for trading the standard size contracts. To trade the micros, it's just a tenth. So look at these numbers and just divide it by 10, and that would have been the outcome. And the required margin you would have needed would have been $50 to take one micro contract. So you've needed $50 to take one micro contract. You would have made $4,100 with a max drawdown of $450. So looking at these numbers, it's a very good return in perspective. But obviously that's the required margin. You would, just rule of thumb, the account size is always determined by your drawdown analysis. So once we get ready for deployment, we can run tests to evaluate what you would call potential drawdowns. Because even this drawdown here is misleading. The reason why it's misleading is because the amount of trades that we took 62 trades. In theory, those 62 trades could have happened in any order. What that means is, let's look at the summary. So we took 33 losers and 29 winners. In theory, these 33 losers could have all happened at the same time. That is why drawdown analysis is important, and we can run simulations to look at all the potential equity curves that would have happened, and that's by randomizing all the actual trades that were taken. So it basically will print us out, like, let's look at the equity curve for this. So this is just one equity curve that was created by the 62 trades that came out. Now we can run a simulation to get 1,000 equity curves, and it's going to plot all these equity curves. It looks like a funnel or a cone, and then we get an idea of the potential drawdown, and there's a good side to this too, the potential returns. And we can see where this specific equity curve fell into the mix. So for example, this equity curve might have been within the 10 percentile, which is misleading, because this just means that this was that this equity curve only has a 10% chance of reflecting in live performance. What we want to know is, okay, what is the average equity curve that we can expect to get? Yes, correct. Just like a Monte Carlo simulation, and there are some other validation tests. This once again falls in a category of validation.
You know what's really interesting? How can Ninja Trader detect that this equity curve will fall at the top, actually, at the top of the ranking, for example, of the equity curves, or of the simulated equity curves? How can he tell this? That's the. I don't know if you understand. I don't know.
A market replay is not more accurate. It heavily depends on how your strategy is built, what type of orders that it's using. There's actually someone who did a in-depth analysis to see if the tick replay was more reliable than the high resolution backtest. And once again, it only relies on how your strategy is designed to update and performance executions. Since our strategy is solely going by bar close, and that's all that's all we're using. Then we can have faith that it's as reliable as it could be, even if we used, a really high resolution right now. Just for good measure, once I get more into validation, I can do stuff like run, do the high resolution tick. But once again, depending on how your strategy is operating, it's very rarely going to make a difference. But it's something you definitely need to be aware of. Anis, I didn't fully understand your question. You can try to tell me again.
So you say you said that this equity curve, the equity curve that we just saw, can be, for example, at the 90 percentile. So it means that this equity curve is better than 90% of the other generated equity curve. My
Correct.
question is, how can the software know that this equity curve is at the higher? How can he know? He
Well,
like
that's completely dependent on how you run your simulation, you know. Um, and so those percentiles are created based on your simulation results. If you print out 100 hypothetical um, equity curves, then this might be in the 20 percentile or 30 or 50 or whatever. Whereas if you print out 1,000 equity curves, it might change that percentile. It's not too much to overthink, and it just kind of gives you an idea. Because we all know that this strategy, you know, is extremely unlikely to just have 33 losses in a row, or those 33 losses are very unlikely to have occurred, in a row. But it's still just good to know what the average of those equity curves might have been, and you want all the equity curves to generally be going in an upward direction. So that gives you to say, well, cool, if these equity curves, if these trades would have happened in any order, then I would have been profitable. Or actually, a better way of saying it is your account size that you would choose for it would have still withstood any potential drawdowns. Because that's what we're really trying to do. We're trying to see the potential drawdowns of the strategy. Because one of the things people, really mess up when they get going is their expectations are heavily skewed. Right off the bat, you should never think that. Just always assume your strategy is going to perform worse live. That's just a rule of thumb. Just have the least expectations for the performance possible. If it starts
okay, you should
to
add.
if it starts to do well live, then that's when you can start scaling up. You can increase your exposure. But everything we do obviously is going to try to ensure that we get the most realistic, or that our expectations that we come to through testing will match up with what happens whenever we go live with it.
Okay, so let's put it this way. So You are expecting to see your the average return that is generated by the simulation, right? That's your expectations. You expect to see the average return on the simulation. Yes,
Sure,
it's the yeah.
we
So
we we could say that, yeah.
so the in reality, is this what's happening? Do you see the average returns like consistently or less than the average return? Because you are the experienced. That's I'm trying to go to get the insight.
Yeah, well, that really makes me want to talk about strategy variations, and there's a whole topic about this. Like, I plan on making videos specifically around what you would call seeking the average return, and there's a lot of ways to go about that, and it's definitely a, a best practice when it comes to, you know, deploying. And I'll just give a quick example. I'm going to give a quick example without ranting too much. Let's say you have a very simple moving average cross. The strategy enters long when the fast moving average crosses above the slow, exits when the fast moving average, it doesn't reverse, it just exits whenever the fast moving average crosses below the slow. And so let's say we're using the 10 and the 20. And then we run some optimizations. And let's say we run the optimization from 10 to 100 on both of the moving averages. And it's profitable on all iterations, right? So the 10 and the 20 is profitable, the 20 and the 30 is profitable, the 30 and the 40 is profitable, so on and so forth. So I just spoke privately not too long ago, going over this exact thing with a member, and he was confused about, well, why not just choose the best performing one, you know? This same concept applies with running strategies on different products as well. Like here, NQ performed the best. So why not just run the strategy on NQ, you know, and then take additional size? Reason why we don't want to do that is because, one, there's an initial bias right off the bat, okay? So back to the moving averages, we have, let's say we choose to run let's say we choose to test the 10 and the 20, the 30 and the 60. So basically the moving average is double every time. So we got, let's say we ran the 10 and the 20 and the 30 and the 60 and the 50 and the 100. All right, they're all profitable. And so let's say, you know, well, the 30 and the 60 is doing great, so we're just going to roll with that one. The issue is that maybe next month, the 50 and the 100 performs best. And then maybe the month after that, the 10 and the 20 performs best. We never know which one's going to perform the best. What we do know is that, let's say we test historically, and the average return of the combination of those variations is 5%, right? Normally you look at P&L because percentage returns are very misleading. But let's just say, you know, 5% is the average return from using all the moving average variations. But then you run a little test and see, oh, well, historically I could have gone 10%, or, you know, the 50 and the 100, if I only ran that one, it would have gave me, you know, 20%. When you're only running one, you're susceptible to the performance of that individual strategy. So let's say you run it for 12 months, and on January, boom, gives you 20% return that month. But then next month, it gives you minus 10. So on and so forth. At the end of the year, the strategy is likely to produce you the average return overall, which might have been 5% after all the months. So over the course of the whole year, you achieved 5% because you incurred those swings. Whereas if you used all variations, your average return per month could have been 5%. Falls in the same line with running different products. You know, NQ did best this month. Next month, ES might do the best. NQ might fall off some. But since you're getting that diversification, you are still achieving the average return overall.
Got you. So the main idea is to always use multiple variation of the same strategy that we can aim for. We can at least get the average return. Is this correct?
Correct. That's the whole purpose behind variations. It's additional diversification to one, ease
Start.
your drawdowns, and to maintain the average return, which is also why the drawdown overall is decreased. Because like when we first ran some tests, you were like, man, I bet that equity curve is really smooth, you know. But of course, we can't see it here on Ninja. But it is really smooth because it kept that consistent average growth, which is what gives us those better Sharpe ratios. Whereas if we only ran it on the NQ, you know, if you look at the NQ curve, you know, the Sharpe ratio probably wouldn't be nowhere near as good as the portfolio curve because the volatility and the swings are much greater. That's why we don't really look at individual strategy curves. And anyone that posts an amazing strategy curve is, you know, is probably some overfit trash. Those beautiful equity curves are for portfolio, having a good Sharpe, good diversification. Overfit trash.
Hey, can you hear me?
Yeah, I
Is
can
it
hear you.
working?
Yeah, I can hear you.
Yeah, cool.
Sound good.
Could I ask a real quick question on do you care at all about average winning trades or average losing trades and percentage percentage of trades profitable? Like, does that matter to you, or are you just like, as long as it makes money, kind of thing?
So it depends if I'm looking at it from a portfolio standpoint or an individual like product strategy standpoint. But average trade is my favorite metric by far. And average trade is a metric that I look at the most when going live. Average trade and the win percentage. So, you know, like here on the combined results, the average trade is 200. That's going to be the key metric that I look at whenever I start to add any type of rules or anything, because really it's just a much more important metric in terms of scalability. So if I create a rule, you know, if we add something to this strategy that gives us, you know, maybe a lot more profit, but the average trade is like, you know, heavily corrupted, and I'm probably not going to take that. You know, I'm probably just not going to take that rule. Whereas if I add a rule, a lot of times I'll add a rule with a specific idea in mind. You know, if it's to lower the drawdown, then I want to see a lower drawdown after I add that rule, even if it decreases the profit. So, you know, if I make a new rule that makes the total net profit 50,000, but now it brings the max drawdown to 3,000, then I consider that a pretty good add. And in most cases, decreasing the drawdown will also increase your average trade. But yeah, average trade, win rate, fantastic metrics. I love them.
Okay, cool. And on designing systems, is it still working? Can you hear me?
Yeah,
Yeah.
yeah, I can hear you.
Yeah. On designing systems, obviously, like you've got the experience to know, okay, this is my this is my theory that I have, and this is the premise that I'm working on.
Mm-hmm.
It's like tradesmen know what tool to reach for. It's like how do you know what tool to use? Like, is there any resources that we can look at for like, I want to do, or like this set of indicators works good for trend following, and this set of indicators works good for mean reversion, but you know what I mean? It's like you don't, if you're trying to hammer something into the wall, you don't use the battery of a drill, like you use a hammer kind of thing. Does that make sense? Or
Oh yeah,
because I
it
don't
makes
even know
sense.
what what indicators to pick or what works and what doesn't. I'll just be like combing through the desert trying to see if it works kind of thing without actually seeing
Yeah,
if the strategy works.
yeah. So that's a really good question actually, and something I haven't given a whole lot of thought to yet. But you're absolutely right. People who are newer and don't have a lot of experience looking at indicators or I guess fully understanding them probably is going to find it a little bit difficult to trying to find ways to exploit these patterns in a very simple way. um, as far as resources go, I don't really. I mean, yeah, you can read about individual indicators, but I don't really think you could type in Google like, how can I use indicators to exploit this pattern? Like,
Yeah, you can use anything to do anything. It's just it some stuff works, but like anything that's a blunt object can be used as a hammer kind of thing. But
I mean, me personally, I've went down the rabbit hole in the past for years looking at just every freaking indicator that is out there, and so I can pretty much like I just know how to exploit. I can think of indicators to exploit almost anything. Whereas if you don't have that capability, then it's just going to be trial and error, unfortunately. Or you have
okay,
or,
okay,
but of course you have us, so you could easily
yeah,
ask
yeah,
me, like how do you think I can have like a dynamic target that doesn't take away from this, you know, and I can give you
yeah.
a ton of ideas.
I've only ever worked with price action for. I've been trading for 16 years, but I've only ever done price action. I've never touched indicators,
Yeah.
so this is all new for me.
And so there's actually a video. I know Anis is really familiar with Darwin X. I don't know if you are as well. But I'm gonna post his. He has a playlist of like over 100 episodes on creating algorithmic strategies the right way, and a lot of the way I teach and do everything falls in line tightly with his approach because we look to do the exact same thing. Use indicators to exploit patterns. We start with looking at the chart, identify what pattern you want to exploit, use indicators to exploit it, create a baseline, build upon the baseline, ensure you're not over optimizing, robustness tests, checking out walk forward optimization. I could keep on going because it keeps on going. But
Oh, it makes sense.
yeah, like he really does a good job. And he also has a video just on that topic where he recommends doing exercises with you pull up paint on your or any drawing, it ain't gotta be paint, just a drawing tool. And so you pull up an indicator on your chart, like an oscillator or the RSI or whatever, and you just look at only the indicator, take price out, just only look at the indicator, get your pen and paper, and try to just draw a line chart that, how you think price action would look, or how you think price should look given the way this indicator looks. And then once you finish, and I'm not talking about, drawing each individual candle. I mean just a line chart, a very
Right.
general
Yeah.
line chart. Um, and then look at price and see if your line chart, you know, matches up with the indicator. And if your relatively close, that means that you now understand how that indicator operates. And of course, you can look at the formula of the indicator and whatnot, but that
Doesn't
doesn't
mean anything.
that doesn't really give you a lot of insight. But like just staring at the indicator, staring at price, seeing how it operates, is really useful.
No, that's really helpful advice. Thank you.
Yeah,
I've
man.
got one more question on the systems thing before we move on, if that's okay.
Yeah, for sure.
So it seems like we're almost when we come up with an idea, it seems like we don't want to overfit or complicate in any way. We want like the widest goal or the widest hoop to shoot through. And we almost want to like build it in a way that's binary, like it either works or it doesn't. Like it's either the very most basic sort of premise of it is either flawed or it works, and we want to test like I guess we want to test like if the concepts sound in the first place, or am I just rambling here?
I think I know where you're going,
I don't really
and
know how to articulate it.
it's kind of like create, if we use whatever indicators to enter on whatever pattern, then it's kind of like what I was saying yesterday, and you even took a note on this. What determines the profitability is solely relies on if that pattern is occurring often enough. And so that's all we're really trying to find out with our initial testing. Now, if we use some combinations here, like if we used some type of condition that does not get us in on an opening range breakout and holds us through, a normal trend, then we're not getting much value from that. We're not really seeing the true core performance of that pattern. So
I just got more clarity. I think I've worked out my question.
okay,
Um, I think it's like you want to what you're initially testing for. Correct me if I'm wrong or if this is incorrect, but what you're initially testing for is how often does this pattern work and how often is this occurring successfully. And it's not so much about how much money it makes or how successful it is when it does. I mean, obviously that counts later, but it's seeing if that is something that you can exploit uh,
exactly. I mean,
a
yeah,
lot over time because like you said before, it comes down to the average trade. Black swan events are one thing, but it's like you're counting on the average, so you want to see how often that occurs, not trying to squeeze the life out of it from the beginning, kind of thing. Is that correct? The sort of way of looking at it, or
yeah, I think that's a good way of looking at it. Running some initial tests, seeing if that pattern is prevalent and worth trying to exploit.
then you work out what's the best way to actually exploit it.
Yeah.
First, it's like binary. That was my sort of question. Like, first you work
Okay.
out
Yeah.
binary,
Yeah.
does this work? And then you figure out the best way to do it.
Yes.
Like the
Precisely.
how.
So, yes, it's definitely very binary at first, and this type of pattern is extremely simple to make binary, whereas other patterns take a little more effort into trying to quantify, how to exploit it in the most robust fashion. Because that's what we're trying to find out, is if the way we're trying to exploit it, is it robust? And then we can run it on different asset classes, like this, this opening range breakout does great on the indexes, but is it going to do, is this pattern as prevalent, on um, agriculturals or energies or forex, stuff like that. But once it is, I mean, if this pattern just does terrible on live cattle or terrible on coffee, I'm not going to run it. And it's good to get that baseline um, to try to get a feel for what assets you want to try to build the strategy on. and then we can create a custom instrument list and just kind of build on that on the asset classes that it's performing good on. It's like we found out yesterday, forex not very good for momentum strategy, so we're probably not going to look to further make that pattern on forex. Whereas someone who might be approaching it the wrong way might say, oh, well, this baseline does terrible on forex, but let me optimize these parameters and see what happens. Oh, wow, optimize the parameters, now we're doing great. And then go live and it just does terrible, because all you did was overfit the shit out of it. But we have a baseline now with for this strategy. We know that just the core premise of this strategy is profitable. More than likely, you're going to make money with it. So now it's just kind of tweaking things while at the same time ensuring we're not taking away the robustness. And that's the goal. That is 100% the goal from here on out. Right now, we're as robust as we can possibly be. So the goal is, how can we boost performance without taking away robustness? Because being able to run a strategy on multiple assets is what truly gives those good, nice equity curves, sharp ratios, drawdowns. Like that's when the metrics really matter.
That's great. Thank you for that.
Yeah. So the market is about to open. So we have to hop off here. I think it was a good session. We got the baseline strategy built. We didn't test on any of the other asset classes, but we'll definitely, get to that. I should be doing a session later on, but it'll probably be a different crowd because all of these are like my European people, I think. I haven't figured out how I'm going to do that yet. Because if I move on with this later on in the evening, then y'all might have to just, watch that before joining for the following morning session tomorrow. That way everybody can, stay on track. And definitely, if you haven't completed the project yet, please do that so that I can just, the whole purpose of it is to just make sure that you have everything installed, ready to go. You know how to build, you know how to build the strategies, ensure that you have everything ready to go and you're ready to learn and follow along, That's the whole point of the project. And, if people don't do that, whoever doesn't do that, then it just shows to me that, and of course, there's situations where you might be simply incapable right now. You just don't have the capabilities of doing the project. And of course, in special cases like that, hit me up. But a lot of people haven't even done anything with it yet. A lot of people aren't joining the live sessions, meaning that they're just drifters or not motivated enough or something. There's something going on there, and I want to keep this group as focused as possible, all motivated, critically thinking, so that we get it down to a nice, solid bunch of people that can make some truly amazing stuff. All right. I hope you all have a good one, and I will see some of y'all later on.
It was great. Thank you.
Yeah, man.